Welcome to Trader TV, your insight into trading for professional investors. I'm Ruth Emery. Derivatives can optimise returns and lower costs for investors. However, their investment managers need access to these instruments efficiently to realise those benefits. Bartholomew of Eurex, Lloyd of NatWest Markets, and James Wallin of AllianceBernstein are here to discuss how buy-side firms can do just that. What is an asset manager looking for from its derivatives trading operation?
Fluidity, the ability to, enhance alpha in a nuanced way, and to be ready to trade across the spectrum of, agreed upon instruments. We have numerous accounts that need to be up and running, both with a clearing broker and a full suite of executing brokers. Mm-hmm. So our job in terms of, the middle office, back office solution for derivatives trading is to make sure that our accounts are all papered.
I have a role to ensure that my customers on the buy side are fully papered and documented, and that includes all funds under an ISDA, for example, so they can trade on block, and ensuring that I have a responsibility for the terms, because while my legal or docs team might have a view, I need to take ownership of risk appetite for what is within the envelope and to ensure that our relationship with our customers is more of a partnership.
So Lee, how will the end investor see the benefits of efficient derivatives trading?
Having an efficient trading setup allows the trading desk as well as the portfolio managers to focus on alpha, especially in fixed income. That's becoming more challenging with the growth of passive and so forth. So you definitely want more focus on your execution. I think it has allowed, and certainly through 2020, you've seen an acceleration of technology.
Sure.
By having the operational side comfortable and you've got that seamless kind of transition, it makes engaging, whether it's at our level or on the sell side, a lot easier because you're focusing more then on kind of ways to make the market safer, mm-hmm. more robust, but also, I would say, more liquid.
The efficient outcome would be that our customers are able to access our liquidity in an efficient manner, allowing them to serve their end users. And obviously, they have an obligation with their end users to ensuring the best outcome, which is a function of many factors, including best price, speed, and ability and confidence to handle large trade size, etc., etc. So if we do our job and they do their job, then their end customers will have the best outcome. Mm-hmm. And that comes down to reducing any friction, be it access to liquidity or documentation or not having any trade breaks, for example.
Phil mentioned that he's responsible for, among other things, the overriding terms of the arrangement. And that's important because, you can gain alpha on the trade and give it up on the back end if you don't get the terms right. And that's important for buy-side participants to understand and for their sell-side partners to agree to ahead of time.
And how are operational, market and execution risks overcome by the effective operational setting up?
As the buy side becomes more electronic in their process and automated, that then frees them to focus on their cash side of things and alpha, but then it also focuses on what we can do going forward and new innovations, really.
The greater stress that's in the market, as we saw during the initial weeks of the pandemic, the more important the terms are in terms of making sure you can keep your trades on and don't end up with an event of default that you hadn't even thought was possible. We did well during the pandemic because we had given a lot of thought to that and worked with our partners on the sell side.
When I speak to heads of trading at buy side, it's incredible how much they have an understanding now of market structure reform. So what happens in the post-MiFID II world, wholesale mm-hmm. markets review, Europe coming out with their tweaks to MiFID II, you tinker with the edges of rules and you create a butterfly effect. And that could impact liquidity, operating rhythms, in context of risk appetite. And so the more that we are all communicating in a transparent way, the better the overall outcome. Mm-hmm. So that comes back to the front office taking more ownership front to back. As you automate more, the relationship becomes a more important part of that ecosystem.
What are the risks of inefficient trading?
In the pandemic, the market accelerated through a lot more bottlenecks, right? And when you're looking at margin and setup, especially for the buy side, the easier you make it to access, whether that's operationally, risk, or liquidity, it makes a big difference. And also from an exchange perspective, you're focused on margin because it's becoming more and more important, right? And if you're not focused on the operational side, then slippage on execution and liquidity becomes even more prevalent.
Inefficiencies, I guess, will lead to bad outcomes for our customers, operational headaches, being painful to do business with, which starts to erode years and years of building up a trusted partnership relationship. So if trades are breaking all over the shop and we're not there for when they need us, be it market stress or normal markets, that's how I would interpret inefficiencies.
I'd like to thank James, Lee and Phil for their insights today, and of course you for watching. To catch up on our other shows or to subscribe to our newsletter, go to tradertv.net.